Hi, have you ever wondered how many properties you would need for financial freedom? I'm Michael Yardney, and I've found that while most property investors hope to one day replace their personal exertion income with cash from their investment properties, most don't have a strategy. They don't have a strategy to achieve that. So how many properties does it take to enable you to quit your day job and live comfortably? The answer's simple. It depends. Okay, look, I know that's not really what you wanted to hear, but in fact, it's not the wrong question. It doesn't really matter how many properties you own. What's more important is the value of your assets and how hard your money's working for you. Before I go on and explain that a bit more, I just want to mention that if you want to build a substantial property investment portfolio, if you want to have a property investment business that will one day replace your personal exertion income, you should consider buying my great book, What Every Property Investor Needs to Know About Finance, Tax and the Law. I've co-written this with 3 other property, legal, finance and tax experts to show you how you can get the system working for you, not against you, and you can build your own property investment business. So you can click on the link below or on the site and get your own copy of this great book. Okay, back to what I mentioned a few minutes ago about it's not how many properties. You see, I'd rather own one Westfield shopping centre than 50 secondary properties in regional Australia. Have you ever thought about how you're going to actually live off your property portfolio? You see, most people think they're going to replace their income, but weren't really sure exactly how. They think maybe it's the rent. They don't actually have a strategy. They don't have a plan. They just hope it's going to happen. As I said, others actually hope they're going to do it living off their rents. Yet I rarely see that happen. It's just too hard to grow a portfolio of cash flow positive properties, one of sufficient size to replace your income. On the other hand, the wealthy investors that I deal with have built a cash machine by growing a substantial asset base, an asset base of high growth properties, and then they slowly lower their loan to value ratios so they can then transition into the next phase, the cash flow phase of their investment life. So how do they lower their loan to value ratios? They do it in a couple of ways. First of all, they stop or slow down buying properties so that the value of their property portfolio keeps increasing while their loans remain much the same. That lowers their loan to value ratio. Others add value to their properties by manufacturing capital growth through renovations or development. Others pay off the debt using superannuation. Yet others reduce their debt. They pay off principal and interest. That way it speeds up the debt reduction. And some just sell a property or two. So they build a big property portfolio and then they lower their loan to value ratio. But the first stage of their wealth creation strategy always involves building a substantial asset base. Look, you could be thinking, well, Michael, can't I just live off the rent? Let's do some sums. Imagine you want to have $100,000 income. How are you going to achieve that? How many properties would you need to achieve it? If you eventually plan to pay off your debt and have a property portfolio with no mortgage so you can live off it, you'd need at least $4 million worth of properties with no mortgage, as well as your home, to get that $100,000 after-tax income. Don't believe me? Look, let's look at it. The average gross income for well-located properties in Australia is around 4%. But I'm going to be generous and say you earn 4.5% across a property portfolio of good properties. This means if you eventually own, let's say $1 million worth of property with no debt, you get $45,000 rent. But you're still going to have to pay rates and taxes and insurance and agents' commission and repairs and have the vacancy periods. So that may leave you with, I don't know, something like $35,000 a year. And then you'd have to pay tax on that, wouldn't you? When you do the sums, you see that you'd need an unencumbered portfolio worth, I don't know, $4 million, $5 million to earn at least $100,000 after tax each year. Remember, that's $4 million worth of property with no mortgage, otherwise your cash flow would be lower, and you still have to own a home. Let me ask you a question. Will you ever be able to save $4 million? Will you be able to build a portfolio that size on a few dollars a week positive cash flow from your rents? So by now it should be clear that the only way to build a substantial asset base is to take advantage of the leverage, power and compounding growth of high growth properties. In my mind, the only way to become financially independent through property is to first grow a substantial asset base, of course by buying high growth properties, and then slowly transitioning into the next stage, the cash flow stage, as I explained, by lowering your debt. But not by paying it off completely. Here's how it works. Fast forward, 10, 15 years, and imagine you own your own home and you've got that $5 million worth of well-located properties. Now, if you had a typical 80% loan-to-value ratio, you'd be negatively geared, wouldn't you? On the other hand, if you paid down all your debt and you had no debt, you'd have positive cash flow, but you'd forego the benefit of leverage and gearing to help your portfolio keep growing. Now, somewhere in the middle, maybe around 50%, of loan-to-value ratio, your property portfolio would be self-funding. You'd even have a little bit of cash flow left over, but not enough to live on. If you think about it, it'll be much easier to amass a $5 million property portfolio with $2.5 million worth of debt than the same size portfolio with no debt. You could then go back to the bank and explain that you've got a self-funding property portfolio. It's not reliant on your income. And you may even have a little bit of cash left over, just a bit for serviceability. You then go and say to your bank, or probably more appropriately your finance broker who understands the system better, you say, look, could I have a $100,000 loan? So you're just increasing your loan-to-value ratio slightly. The good news is you don't have to pay tax on this money because it's not income. But you would have to pay interest, wouldn't you? Because it's for your own personal exertion, for your own personal living. You'd have to, the interest wouldn't be tax deductible. But this means after interest payments, you're still left with, $93,000 to live off. Let's crunch some numbers. At the end of the year, you've eaten up your $100,000. But in a good year, your $5 million portfolio of properties, if you've got good located properties around Australia, may have gone up $500,000. In an average year, it should have increased around $400,000. Let's imagine it's a bad year. Your portfolio may have gone up $150,000, $200,000. And of course your rents would have increased because your properties have increased in value. Now sure, you've used up your $100,000, the money you borrowed and paid the interest, but because your portfolio has risen in value, along with the rents, your loan-to-value ratio is lower at the end of the year than it was at the beginning. So you finish off the year richer than you began it. Now you truly have a cash machine. And of course you can do this over and over again. Now you're probably thinking, Michael, does this really work? Okay, in the old days, living off equity was easy. You just had to go to any bank and get a low doc loan, and as long as your properties increased in value, it was smooth sailing. Yes, it's harder to do today, but it's definitely doable. A lot of our clients do it. You just have to lower your loan-to-value ratios to show serviceability to the banks. Needless to say, you can't achieve this overnight. It takes time to build a substantial asset base. It takes time to lower your loan-to-value ratios to a comfortable level. But if you take advantage of the magic of leverage, compounding and time, it happens. Of course, this strategy depends upon the growth in your property portfolio and, just as importantly, your ability to ride the property cycles. This means that as you build your portfolio, you're going to have an asset protection strategy to see you through the ups and downs, because we are going to have ups and downs. Look, after all, in the next 10 years, as you grow your portfolio, we're going to have some good times, we're going to have some bad. There's going to be periods of high interest rate and periods of lower interest rate. We're going to have periods of strong economic growth. There's going to be times of downturn. Savvy investors count on the good times, but plan for the downturns by having an asset protection plan. They've got a finance strategy, and they make sure they set up their structures in the most effective way. Remember, I was explaining to you that that's what I cover in my great book, What Every Property Investor Needs to Know About Finance, Tax and the Law. So don't get me wrong, I've just made gaining financial freedom from property investing sound simple. But it's not easy. And that's not a play on words. Fact is, 20% of all those who get involved in property sell up within a year or so. Close to half sell up within 5 years. And of those who stay in the property game, 90% never get past their second investment property. You've heard that before. So if you want financial freedom from your property investments, if you want to be able to fund your dreams, you're going to have to do something different to what most property investors are doing. You're going to have to listen to different people to who most property investors are listening to. You're going to have to set yourself some goals. You're going to have to follow a strategy that's known, proven and trusted. And then grow your portfolio business, your property business, one property at a time. As I said, of course, you need to own the right properties. Ones that have a level of scarcity, meaning they're going to continuously grow in value. Owner-occupiers are going to keep wanting to live in them and push up the values, and tenants are going to want to rent them to subsidise your mortgage. Your properties are going to have to be in the right location, ones that outperform the averages, and you should buy them at the right time in the cycle, which actually is probably a good time now in many states. Lastly, you've got to buy the right price. And to be a successful investor, you're going to need to surround yourself with a team of independent and unbiased property advisors. Not salespeople. A team of people who are known, proven and trusted. So probably appropriate at this time to remind you that in uncertain economic times like we're experiencing, no one can quite help you like the independent property investment strategist at Metropole. Remember, the multi-award winning team at Metropole got no properties for sale, so their advice is independent and unbiased. If you want to find out a bit more about what's happening in your local markets and what our research suggests is in store for you, why not join the team at Metropole at a free property briefing in Melbourne, Brisbane, Sydney, or one with our associates in Perth. Just click on the link below to find out more and reserve your place.